Now, just a few questions we had about investment structure. Kim asked, what is the most effective way to manage savings in the retirement period? Well, in the retirement period, as we mentioned earlier, it's great to have your retirement assets in this 0% tax environment of the pension phase. There are also benefits of holding it in the pension phase from a Centrelink perspective, particularly if your age pension is being reduced by the incomes test. So if you're doing some part-time work, having assets within the super environment or the pension phase of super, it can increase the age pension that you're receiving. Ian asked, should an investment property be sold and the proceeds put into super? It's a common strategy, Ian, that if you've got an investment property or other assets, whether they be shares, prior to retirement, put that money into the super environment, because you end up paying no tax in this pension phase, and also there are Centrelink benefits, as I mentioned earlier. The other thing is, you can actually potentially hold an investment property and earn rent on an investment property and not pay any tax on that money, because the rent is below, if you're holding it jointly, it's below $40,000 and you can pay no tax. And you're not having to worry about the whole superannuation thing. The difference between that and superannuation is that in pension phase, you can pay no tax if you sell the underlying asset as well, whereas you'll pay capital gains tax at some point when you sell the investment property. We have Jennifer who says, with the ongoing poor performance and uncertainty of investments in super scheme, am I better off taking all my superannuation and placing it into a higher interest bank account and living off the interest? The fees are as much as the interest earned in the super account. Would I pay tax on the interest? What is the cutoff as tax-free? Jennifer, well, we talked about that here with these are the tax-free thresholds if you earn less than $20,000, $20,500. But the potential drawbacks to that is that if you have assets over the assets test, then it can impact you from an age pension perspective. If you, for example, get an inheritance later on, I often meet people in their 70s who can't get money into their super fund because they can't satisfy the work test. They're paying tax, and they're a little bit frustrated because they can't do anything about it. There are some scenarios, if you've got a small amount in your super fund, pulling it out doesn't make any difference from a Centrelink or tax perspective. That's fine. But if you're thinking longer term, often it's best to maintain in that pension phase of superannuation. And just one more question from Margaret about structures is, we have 3 investment properties with an equity of about $800,000 and we only have about 60 in super. Would it be best to sell off the investment properties and put the money in super, or invest it all in one mortgage-free residence? And is there a time pre-retirement when it is best to do this? If you were going to put the money into your super fund, then there are contribution limits of $150,000 per annum, or if you're less than 65 years of age, you can put $450,000 in 1 year, or over a 3-year period. So the key time to which you need to make that decision is probably a few years before the 65 years of age. And based on, if you've got 3 investment properties and $800,000, there's potential that you might end up paying tax if you invested all that money in your individual names. Whereas holding it in the pension phase of super, you'll pay no tax, you potentially increase your Centrelink benefits. So I would at least consider that as an option over time. If you've got capital gains tax issues with those investments, we can deal with that, and we'll talk about that later on in the session.